Hello, I'm David Hardesty, and in this lecture we learn the ways in which U.S. tax treaties determine the amount of business income of a foreign taxpayer that is taxable in the United States. The objectives of this lecture are to understand the following: the way U.S. tax treaties limit U.S. tax on business profits that are attributable to a permanent establishment in the United States, the meaning of business profits under U.S. tax treaties, determination of the existence of a permanent establishment in the United States, and the attribution of business profits to a permanent establishment. In general, where there is a U.S. tax treaty, a foreign taxpayer can elect to apply the treaty so as to be subject to tax in the United States on business profits only to the extent those profits are attributable to a permanent establishment in the United States. Here's how to analyze this rule. If a non-resident alien or foreign corporation or other taxable entity is a resident of a country with which the United States has a tax treaty, and if the foreign person is entitled to the benefits of that treaty, then the foreign person is not subject to tax, U.S. tax on business profits unless two tests are met. The foreign person has a permanent establishment, or PE, in the United States, and the business profits are attributable to that PE. This permanent establishment rule is provided by Article 7 of the U.S. Model Tax Treaty. Here's an example of the permanent establishment rule. Foreign Corp is a Country X corporation engaged in consulting services. During 2010, 10 of its consultants each spent 4 months in the United States servicing U.S. clients. Assume Foreign Corp does not have a permanent establishment in the United States. Under Section 864, Foreign Corp is engaged in the conduct of a U.S. trade or business and would ordinarily be subject to U.S. tax on the U.S. source income that results from those services. However, because it does not have a permanent establishment in the United States, it can avoid U.S. tax on this income by claiming the benefits of Article 7 of the treaty, which limits U.S. tax to tax on business profits attributable to a permanent establishment. Here's an example of the permanent establishment rule as it applies to a partnership. Foreign Co. Limited is a service partnership formed in Country X. It has 5 partners who split profits equally. 4 of the partners are Country X residents and perform personal services only in Country X. 1 of the partners performs personal services through a permanent establishment in the United States. The 4 Country X partners may be taxed in the United States on their respective shares of the income attributable to the permanent establishment in the United States. The services giving rise to income which may be attributed to the PE would include services performed by the U.S. partner. This example is continued on the next slide. In addition, income attributable to the PE would include income attributed to the services of one of the 4 other partners if that partner came to the United States and worked on matters involving the U.S. office. Income from services performed by the visiting partner would be subject to tax in the United States regardless of whether the visiting partner actually visited or used the U.S. office in connection with performing services in the United States. The key to Taxation of business profits of a foreign person from a treaty country is the existence of a permanent establishment in the United States. So, what is a permanent establishment? Under the U.S. Model Tax Treaty, Article 5, the term permanent establishment means a fixed place of business through which business of the enterprise is wholly or partly carried on. A fixed location can include any type of business premise. A permanent establishment includes a place of management, branch, office, factory, or workshop. It also includes a natural resources well, a mine, quarry, or long-term construction site. Here's an example of activities carried on in a location that can create a permanent establishment. Foreign Corp is a Country X corporation engaged in the manufacture and sale of shoes. It rents an office in Tennessee and staffs the office with employees who make shoe sales to retailers in the United States. This is a fixed location through which business activities are carried out and constitutes a permanent establishment. Accordingly, business profits attributable to that office will be taxable in the United States under a tax treaty based on the U.S. Model Treaty. The Model Treaty includes examples of the places of business that are permanent establishment cited in the previous slides. And it includes examples of places of business that are not permanent establishments. In general, a permanent establishment does not include a place of business that is engaged in preparatory or auxiliary activities. These activities are activities that are not core business activities. Core business activities include those activities the business was primarily organized to perform. For example, core business activities of a retailer would include taking and processing orders. And non-core business activities would include warehousing of merchandise by the retailer. The U.S. Model Tax Treaty provides several examples of places of business that do not create permanent establishments because they are not engaged in core business activities. Here are examples of activities carried on in a location that do not create a permanent establishment. The use of facilities solely for the purpose of storage, display, or delivery of goods or merchandise belonging to the enterprise. The maintenance of a stock of goods or merchandise belonging to the enterprise solely for the purpose of storage, display, or delivery. The maintenance of a stock of goods or merchandise belonging to the enterprise solely for the purpose of processing by another enterprise. The maintenance of a fixed place of business solely for the purpose of purchasing goods or merchandise or of collecting information for the enterprise. The maintenance of a fixed place of business solely for the purpose of carrying on for the enterprise any other activity of a preparatory or auxiliary activity character. And the maintenance of a fixed place of business solely for any combination of the accepted activities mentioned in the previous slides, provided that the overall activity of the fixed place of business resulting from this combination is of a preparatory or auxiliary character. Here's an example of a fixed place of business that does not perform core business activities. Foreign Corp is a country X corporation engaged in manufacturing software. It maintains offices in Michigan staffed with several of its employees. These employees are engaged in the following activities: purchasing of materials in the United States which are sent to country X for processing, maintenance of a stock of software inventory, and shipment of software to U.S. customers. One requirement for a permanent establishment other than a permanent establishment created by a dependent agent is a fixed place of business through which a business is carried on. In determining whether a permanent establishment exists, the place of business must be fixed in the sense that a particular building or physical location is used by the enterprise for the conduct of its business, and it must be foreseeable that the enterprise use of this building or other physical location will be more than temporary. Here's an example of the determination of a fixed location. Foreign Corp is a country X seller of enterprise software. It employs Smith as its U.S. representative for both consulting and installation of the software. Smith does not work for any other company. Smith goes to client locations in different cities, consulting and installing software. However, Smith has a permanent office in the United States to which he always returns after making consulting and service calls, and from which he runs his U.S. operation. Assume Smith's activities represent core business activities of Foreign Corp. Because Smith performs core business activities and runs his operation from a fixed place of business, his place of business is likely a PE. A foreign entity can have a PE in the United States if its business activities are carried on through agents. In general, where a foreign entity carries on business activities in the United States, it does not matter for the PE analysis whether those activities are carried on by owners of the entity, employees of the entity, or agents of the entity. As we will see, however, as an exception to this general rule, an independent U.S. agent acting on behalf of a foreign principal usually does not create a PE. As I mentioned in the previous slide, an independent agent usually does not create a PE in the United States. Under this exception to the general rule, an enterprise will not have a PE merely because of an independent U.S. agent acting in the ordinary course of business. This exception applies when the foreign entity carries on U.S. business activities through a broker, general commission agent, or other agent of an independent status, provided that such persons are acting in the ordinary course of their business as independent agents. An agent with independent status is generally an agent who is not dependent on the foreign principal. Being dependent often refers to being economically dependent. Those who do not qualify as being independent are often referred to as dependent agents. Here's an example that compares an independent agent to a dependent agent. Foreign Co. is a manufacturer of gadgets which are technical gadgets that do something technical. Domestic co is a U.S. representative for foreign corp and operating from a fixed place of business, selling gadgets to engineering schools. If domestic co is in the business of selling technical parts for many other manufacturers, and if sales of gadgets by domestic co are a relatively minor part of its business, then we can safely say that domestic co is independent of foreign co and its activities as foreign co's agent are activities in the ordinary course of its business, so its activities do not create a PE. Domestic co would not meet the independent agent exception, however, if it was economically dependent on foreign co, or if its activities were not in the ordinary course of business. It might be economically dependent on foreign co if, for example, sales of gadgets represented most of its sales. So far, we've been talking about a PE existing in a fixed place of business. There's another type of PE that does not require a fixed place of business. It exists when a dependent agent in the United States has and habitually exercises the power to contract on behalf of a foreign principal. This type of PE is known as an agency PE. In general, a dependent agent is a person who is not an independent agent acting in the ordinary course of business. A dependent agent creates an agency PE if the agent has and habitually exercises within the United States the power to conclude contracts on behalf of the foreign person. An agency PE can exist even if there's no fixed place of business. This is a major exception to the general requirement for a PE. However, before an agency PE can exist, the activities of the dependent agent must be core business activities. Activities that would not create a PE in a fixed place of business, such as purchasing or warehousing activities, do not create an agency PE. Here's an example of a dependent agent who creates an agency PE. Foreign Corp is a manufacturer of semiconductors that are produced in country X. Jones is a U.S. person engaged as Foreign Corp's U.S. sales representative. Jones does not work for any other company. Jones has the power to negotiate contracts on behalf of Foreign Corp, and any contracts made by Jones are binding on Foreign Corp. Jones' activities in the United States create a PE, a permanent establishment. No fixed place of business is required for Jones' activity to create a PE. This example is continued on the next slide. However, assume alternatively that Jones has no authority to conclude contracts in the name of Foreign Corp for the sale of semiconductors, but instead can only enter into contracts on behalf of Foreign Corp for the purchase of materials in the United States for use in country X processing activities. In this case, because the activity, if performed by Foreign Corp, would not create a PE, the activities of Jones would not create a PE. The existence of a related company in the United States does not, by itself, cause a foreign person to have a permanent establishment in the United States. A foreign company does not have a permanent establishment in the United States merely because it controls or is controlled by a company that is a U.S. resident or which carries on business in the United States. Instead, the determination of whether a permitted establishment exists is made solely on the basis of the factors in the previous slides. Whether a company is a permitted establishment of a related company, therefore, is based solely on factors other than ownership or control relationship between the companies. Here's an example of a related company in the United States. Foreign Co. is a manufacturer of clothing that is produced in country X. It owns 80% of Domestic Co., a clothing wholesaler which sells foreign manufactured clothing to U.S. retailers. Domestic Co. represents many different foreign manufacturers. Domestic Co. does not purchase goods from foreign producers, but merely receives a commission for the goods it sells. Domestic Co. meets the definition of a general commissioned broker operating in the ordinary course of business as an independent agent. The fact that it is controlled by Foreign Corp is disregarded in determining whether its activities create a permitted establishment for Foreign Corp. Accordingly, Domestic Co. does not create a permitted establishment for Foreign Corp. Under U.S. tax treaties, business profits are taxable only if attributable to a PE in the United States. So let us discuss the attribution of profits. The profits to be attributed to a permanent establishment include only the profits derived from the assets used, risks assumed, and activities performed by the permanent establishment. In determining those profits, a foreign taxpayer is allowed as deductions those expenses that are incurred for the purposes of the PE, including executive and general administrative expenses so incurred. The Treasury's technical explanation of the model tax treaty provides guidance for the attribution of profit and loss to a permitted establishment. According to this guidance, a permitted establishment is treated as a distinct and separate enterprise, even though it may be legally part of a single enterprise doing business in multiple countries. Attribution of profits to the permitted establishment is based on the arm's length principle set forth in the OECD transfer pricing guidelines. These guidelines are applied by analogy and, where required, are adapted and supplemented to take into account factual differences between a permitted establishment and a legally distinct and separate enterprise. The aim of this approach is to apply the same transfer pricing principles that apply to transactions between separate enterprises to the dealings among separate parts of a single enterprise. Here's an example of a profit attribution. Foreign Corp is a country X seller of clothing. It opens a store in the United States, which constitutes a permanent establishment. The store is owned directly by Foreign Corp. In order to determine the profit attributable to the store, Foreign Corp must take into account transactions between the U.S. and foreign operations as if they took place between independent companies. For example, transfer of inventory from country X to the store would be charged to the store based on prices that would be charged to an independent store. This example is continued on the next slide. In addition, an adequate charge must be made for management, financing, advertising, and other services provided to the store. The profit attributed to the store would be sales made by the store, less the aforementioned expenses, less the expenses incurred directly by the store, such as expenses for occupancy and employee wages. Income from services performed in the United States by an employee can be exempt from U.S. tax under tax treaties. Ordinarily, under Section 864, compensation for personal services performed in the United States is effectively connected income subject to tax. This rule, however, is modified by U.S. tax treaties in the case of employee wages. Under the treaty, wages are not taxable in the United States if the employee is present in the United States for no more than 183 days during any 12-month period. Wages are paid by or on behalf of an employer who is not a resident of the United States. And the wages are not borne by a permanent establishment of the employer in the United States. Here's an example of the employee wage exception. Jones is an employee of Foreign Corp., a Country X corporation that does not have a permanent establishment in the United States. The Country X treaty with the United States follows the U.S. Model Treaty. Jones is present in the United States for 5 months during 2010 and is not present in the United States in either 2009 or 2011. Since he's present in the United States for no more than 183 days during the applicable 12-month period, the wages are not paid by a U.S. resident and are not borne by a permanent establishment. Jones is not taxed in the United States on these wages.